Good morning, everyone. I'd like to thank you all again for joining us here this morning for the 13th annual Go for Israel conference. I'm Alan Dobkin, managing partner of Catalyst Cell Fund. Very honored to be moderating a panel of such distinguished guests from both Israel and abroad, and for all of our esteemed participants in the conference at large. With us today in the panel, we have Dr. George Lam. Dr. Lam is currently the chairman of Macquarie for Indochina, Myanmar, and Thailand, senior advisor for Macquarie Asia, Macquarie Capital, and Macquarie Capital Hong Kong. He has more than 3 decades of experience in senior management positions in management consulting, corporate governance, direct investment, investment banking, and fund management across the TMT, consumer healthcare, infrastructure, real estate, energy, resources, and financial services sectors. Also with us today, we have Mr. Daniel Marcus. He's a senior partner of Amit Polak Matalon law firm. Daniel is a partner active in their M&A activities and has advised on numerous high-profile Israeli market M&A transactions. He's also an expert in high-tech investments. Daniel works with clients across a variety of high-tech fields, including internet, medical devices, life sciences, software, biotech, and pharma. Some of Daniel's landmark transactions include the sale of Retalix to NCR for $800 million and the sale of Solel to Siemens for $420 million. Also with us today, we have Yair Shamir, the chairman and managing partner of Catalyst. As was mentioned, Yair just returned to Catalyst early this year following his time serving the public as a member of the Israeli Knesset and his role as Minister of Agriculture. In addition to co-founding Catalyst in 1999, Yair also served in leadership roles in many of Israel's leading corporations, including Cytex, Elite Industries, Vicon, Shamir Optic Industries, and served as the chairman of El Al Airlines, Israel Aircraft Industries, and the Israeli National Roads Company. And also with us today, we have Dr. Yossi Vardi, who we just introduced, but again, chairman of International Technologies. Again, one of Israel's early tech entrepreneurs with 40 years of experience in building 80 tech companies. I also learned last night 1 Canadian company, which was interesting. Again, he's very well known for co-pioneering and the instant messaging company as a founding investor and the former chairman of Mirabilis, the company that created the highly popular instant messaging program ICQ, acquired by AOL. Lastly, still absent from the panel, which hopefully he'll join soon, as Mr. Daniel Elan. Daniel is a partner in Cleary Gottlieb's New York office and focused on mergers and acquisitions, as well as IP law. Daniel and Cleary have been involved in numerous high-profile Israeli transactions, including Google on its acquisition of Waze, Carlos Slim's America Mobile investment into Mobley, and TPG on its investment into Strauss Coffee, and numerous others. I think we'll start off by just framing global market activities over the last 12 months. I think if you look at the stock markets over the last 12 months, with the exception of China, which we'll get into in a bit later, markets were relatively uneventful over the last 12 months, more or less flat. Global market gains that were enjoyed during the first 2 quarters of the year began to unwind with the woes in the Chinese market correction that began in June. Most notably, equity market activity the last 12 months was really China. The Shanghai Exchange experienced, Daniel, welcome. The Shanghai Exchange experienced an unprecedented increase beginning in Q3 2014, rising more than 130% from 2,200 to 5,200 before the bubble basically burst in mid-June. The correction is now stabilized at around 3,300, at least for now. Now moving on to global M&A activity. Markets were up strongly 2015 year to date, with about 30% increase in transaction volume globally over the same period last year, with 2.7 trillion in global M&A activity year to date versus 2.1 trillion in 2014. The overall number of transactions was down slightly, indicating an increase in the average transaction size. Taking a little bit closer look and kind of activity by region, very strong M&A growth in most global markets. Outlier markets really were Africa, while the small market had pretty extensive growth of about 150% year over year. China quite a large market, had very impressive growth, about 80% year over year, and the US up almost 40% over 2014. A number of markets did, however, experience challenges this year, with Central and South America down 46% year over year, Europe with mixed results, overall flat, and India down 14%. Moving on to the topic at hand, Israel. The M&A markets here have really, fully matured into a very robust, active market. The last 6 years, we're averaging about $15 billion in M&A transactions. 2015 has really now set new records for M&A. We've already this year surpassed $21 billion in mergers and acquisition, representing 52% growth over the same period last year. And this is actually excluding one outlier transaction, which is Teva's acquisition of Allergan, which would have made this number $61 billion. It was a $40 billion acquisition by Teva. I think I'll turn it over to Daniel Marcus firstly from APM. And Daniel, clearly, someone who's very active in the M&A market here. What do you consider to be the main drivers of this tremendous surge in Israeli M&A thus far year to date?
Thank you. Good morning. Welcome, everybody. This is actually a very interesting topic because it involves both statistics as well as psychology. There's obviously a purely economic element to what's going on in Israel. We're seeing many, many deals. As Alain said, a very robust market. Many deals have occurred. There are many deals that we're dealing with as we speak. And so we've seen obviously a very positive move for the Israeli M&A market. I think a few factors can be taken into account, and we can look at them to find the answer of what's going on. One of the elements is certainly the entry into the buyer's market of new countries and new buyers. We've seen over the last few years much movement from China. Many Israeli deals have been done by Chinese buyers. We see, I believe, India coming now to the front. I think we're going to see in the future Indian companies making acquisitions in Israel, so we're going to see movement on that front. And I think we're seeing just kind of a globalization of Israel's M&A activity, such that the typical or the classical buyers, the US buyers, the European buyers that we've seen in the past, there's now competition and there are more players who are coming to bat here for the activity. I think another thing we can talk about is there's a very big element of how much money is being pumped into the system. Obviously, if we look at the VC investments and the money that's coming into the VCs from their investors, there's a lot of money that's been pumped in over the last few years. That money has matured. Investors need to find a way to liquidate, and so we're seeing a push not only from the buyer side, but also from the sale side, from the sellers who are looking to sell their companies. I would actually want to get a little bit into the psychology of what's going on in the country. And I think what I'm seeing and what I'm experiencing, even on a personal level, is a maturity of the Israeli market, a maturity of the Israeli entrepreneurs, and I would say, a raising the bar of sophistication with respect to entrepreneurs, founders, people selling companies. We talk about M&A transactions as being exits. That's the terminology that we use, but if we look at that terminology, we will note that for the founders, the M&A transaction where the company is sold is not actually an exit. It's an exit in the sense that they sell their shares, so the relationship between themselves and their shares and their company is obviously severed. But for many entrepreneurs these days, the sale is just the beginning of a whole new career. And many entrepreneurs are motivated not just by the cash element of the deal, what are they putting in their pockets as a result of the M&A, but also what's the future. There aren't that many golf courses in Israel. So if you sell your company, it's tough to play golf every day. You're going to have to look for something else to do. And the Israeli entrepreneurs are often looking to increase their motivation, increase their passion, and the M&A transaction is not a way to go home and start playing tennis, but rather it's an opportunity to take your technology, bring it to the market, show everybody what you're worth, show everybody what you've done, and really kind of, put it to them, to use the terminology, in a global way. So, we're seeing a lot of transactions where the motivation for the sale by the entrepreneurs is not solely economically based. And a great example of this is a deal that I had the fortune of doing earlier this year. We sold a company that we were involved in the incorporation of, a company called Cyactiv Security, based in Beersheba. We sold them to PayPal. Fantastic transaction. The company was on the road for about a year and a half from incorporation to the sale date. And if you followed the media on this deal, the media talked about, obviously, a very good yield for the investors who put in very little money and took out a lot of money, certainly relative to the amount of time that the money was invested. But most of the media was talking about the fact that this company will serve as the first block in the new cybersecurity center, global center for PayPal in the world. And being very close to the founders, Shlomi Butnaro and Liran Tankman, and accompanying them through the process, and being involved in the, every aspect and every nuance of the transaction, I can tell you that they were motivated not only by what cash they're going to put in their pocket as a result of the deal, but how they're going to get their fantastic cyber protection technology out in the market, how PayPal is going to funnel them through to the world, how they are now starting their new career as PayPal experts for technology, and the Zionistic element of turning Beersheba into a global center for cyber technology and cyber protection was certainly, if not the main factor for the deal, but certainly one of the main driving factors for the deal. So I think that when you see what's going on in the Israeli market and you see the type of people who are driving deals, the types of entrepreneurs, the level of sophistication, they're not just looking at, okay, here's my income at the end of the day. They are looking, okay, where am I going? To whom am I selling? What global player am I joining? What is going to be my position? Not in the sense of I want to have a comfy position and make a lot of money, but am I going to be able to leverage my new company, my new global company, in order to get my technology and my product out there? And I think that this is a very mature, this indicates the level of maturity of the Israeli market, of the Israeli entrepreneurs, and it's actually very exciting to be involved in deals. I think as advisors, as legal advisors, as consultants, accountants, investment bankers, we always need to understand the psychology of the deal, not just the economics of the deal, because they're obviously intertwined. And when you understand the psychology of an Israeli entrepreneur who is oftentimes motivated by passion and motivated by the will to succeed and the will to get the technology out there, especially if we're talking about areas of defense, homeland security, where it's not just a product, it's protection, it's your own country, things that are tied to the army, etc. So we see that a lot, and I think it's a very positive movement for the Israeli economy. And as an advisor, we try to take that into account and really understand the dynamic of the deal.
Okay, thank you, Daniel. I think just before we move on, just put some more quantitative points. When looking at the M&A market this year in Israel, there was a very big surge in tech and healthcare activity. Typically, tech and healthcare are roughly a quarter each of the market. This year, tech with 45% of the total M&A transactions, and healthcare with about 36%. 40 transactions with close to 17 billion in transaction value. And I think Daniel touched upon this, but if we look at what's kind of driving this tech and healthcare M&A, if you look, prior to 2014, roughly about $450 million per quarter of VC investment. And if you look at the last 6 quarters in Israel, we're now basically breaking the $1 billion per quarter, which is $4 billion a year being put into Israeli technology. And this is clearly a huge driver that we're now starting to see some of the effects, and we expect to continue to grow in terms of M&A exits coming up. And then the last point I think that Daniel touched upon was China and other emerging markets really coming onto the scene in Israel. Literally, we analyzed the market. Before 2010, we didn't see one acquisition of a Chinese company in Israel, and very little emerging market activity. Since 2010, there's now been about $10 billion of acquisitions. Again, this is, a very new pool of capital that is now coming into the market. The vast majority of that has been from China. In addition to China on the M&A scene, looking at venture capital as well, I guess part of the growth in VC investment has been China, which we see now in 2014, there was about $300 billion of investment, China investment into venture capital. Thinking about that, Daniel, one additional question to you. Clearly, we've had historically Western buyers and groups investing in Israel, making acquisitions in Israel. Now we're seeing literally from all over the world, whether it's China, other emerging markets. You mentioned India, we're seeing Russia, we're seeing Latin America, etc. Clearly, it seems like this is not a market where it's tough to do M&A, but it'd be interesting to hear your perspective on doing M&A, executing M&A in Israel.
Yeah, I think that anytime you do a cross-border transaction, and we typically do cross-border transactions, you've got to take into account the cultural element. And you've got to know who your buyer is, you have to know who your seller is, whether you're on your sell side, you're on buy side. You need to understand the psychology of both sides of the table. I think Israelis are very unique in many ways, and we can talk about this. This is not a 3-minute discussion, this is probably a 2-day discussion, what makes Israelis special and unique. Many positive aspects to that, obviously. But when you are negotiating, an Israeli company with a huge Chinese buyer, you need to understand what is driving the deal on both sides of the deal, and you need to make sure that the will of both parties will actually meet. And so there's obviously an element of communication to that. There's an element of understanding exactly what the deal is. You need to make sure that your Israeli entrepreneurs are focused on understanding who their buyer is and what their buyer wants, and making sure that there's actually a good fit for the deal. Sometimes we'll do a deal and we'll be moving down the path, and at some point in the deal we'll figure out, unfortunately, in retrospect, and the deal doesn't close for that reason, that what the buyer wants and what the seller wants are not exactly the same thing. So they're talking about money, they're talking about selling shares, they're talking about doing a deal, but the vision going forward is a different vision. And if the vision is not a common vision for the two companies, it's going to be difficult to get the deal done. And even if the deal does get done, the future is not going to be very bright.
Okay, thank you. I think moving on, one of the issues that was touched upon by Minister Bennett, I think I would address this to Yossi. We analyzed some of the M&A exits over the last couple years, and we kind of listed some of them here, but looking at the exits over the last 2 years, let's say there's 45 M&A exits in 14 and 15, about $9 billion in transaction value. This is, and the average exit value was about $200 million. Not too bad if you're an entrepreneur to exit at $200 million, but I think one of the things we looked at was, the Wall Street Journal tracks a list that they call the $1 Billion Startup Club. And they basically, view today in the world, there's about 124 startups that are valued at $1 billion or more. And, you would think that there would be, a representation of Israel on this list, but looking at the actual list, you see only 2 Israeli companies in the list of 124 that break the $1 billion valuation mark, and they barely break the kind of the threshold. I think if we looked at the data at a different way, if you added up all the value of these startups, it's about $484 billion. And the Israeli startups on that list represent about $2 billion, which is very, very insignificant, less than 1%. So the question is, why are we seeing Israeli companies exiting early? Do we think this is a good thing? Should we not be striving to have more $1 billion plus startups? And why do we not see more Israeli companies showing up on this list?
Okay, this question is being asked time and again, and I think there is a major misunderstanding when this question is being asked. First of all, there are numerous of gigantic Israeli companies in Israel, but they have a different name. They are being called Intel Israel, IBM Israel, Broadcom Israel, Cisco Israel, HP Israel. Each one of these companies employ thousands of people, and each one of these companies was created by roll-up of smaller Israeli companies. And I think this is not only very important process, but this is the real basic of the success of the Israeli high-tech. We are a small country with, we are a small country surrounded by huge government. No, we are a small country, and there is no domestic market. We are selling abroad. We are very good in the early stages of the food chain. We are very good in coming with ideas. We are very good in deploying them with no fear. We are very good in taking risk. When it comes to build a scaled up high-tech company or a scaled up any organization, we don't have the means to do it. And I can give you a list of fantastic Israeli big companies which went public, and then when the market, the US market, the Nasdaq market had a recession, they collapsed because there was no fat or sources to support it. When Intel came to Israel, they invested in 65 startups. They have the vision, the strategic vision, and more important, they have the strategic commitment to overcome any downside. So these monstrous first American companies and now also European and Chinese companies, they are building the Israeli startup industry. They are not taking the brains of the people, put them in cans and exporting them like foie gras. The people are staying in Israel, they hire more people, they have the resources, and the entrepreneurs are becoming the angel investors, which is the real start of companies. Companies are being started not by VCs. Companies are started by angels. When we sold, it was mentioned that we sold, me and my young entrepreneurs, young partners who really knew what's going on, I didn't have any idea. When we sold the company to AOL, I invested afterwards in 85 companies. My partner, Yair Goldfinger, invested in, 30 or 40, and this is the process. This is very important. Nevertheless, since we are criticized so many times that we are selling too early, I brought an expert from another field who understands in exit, and I wanted to see maybe we can learn from other areas whether rapid exits are not good or not. Unfortunately, Dr. Ruth completely didn't agree with me, and she was absolutely against rapid exits. But I still think it's suitable in high tech.
Okay. So look, I hear what you're saying and think it's understood, but I think there's also philosophical debate. Actually, my wife has always has this view that are we selling our knowledge? Are we versus actually you have some companies, for example, Teva or Checkpoint, that have actually made it and have become large companies. But are we selling our knowledge too early? Why can't we take it from where we are today and take it to the next level and start creating the tens of billions of dollars companies?
What does it mean we sell the knowledge? The alternative, either you take the company public, and then the knowledge is owned, quote unquote, by institutional investors who work for a portfolio of large capital management companies, and they have no commitment, no sentimental attachment, no strategic attachment, and when the market goes bad, they sell the shares, or you have somebody who has a vested interest in the flourishing of the company. Broadcom invested in 11 companies in Israel. Cisco invested in 10 companies. So what does it mean that we sell the know-how? And if we go public, we don't sell the know-how, we sell the know-how also, but just to a less interested investor.
Okay. Thank you.
I would like just to react on something you said. You said that you have to understand the psychology of the seller. I would like to, if I may, to correct, you have to understand the psychology of the mother of the seller. This is much more important because behind every Israeli successful entrepreneur, there is a mother who is not happy with what she is doing, and this is the real source of the phenomena that we are seeing here.
I think now maybe moving to Daniel Elan. So Daniel, clearly there's numerous acquisitions each year of Israeli startups with little or no revenues for very high valuations in the hundreds of millions and sometimes $1 billion. Clearly there's a lot of variables included in valuation, analysis, etc. But clearly technology and innovation is central to many of these. From your experience, as being involved in many of the leading transactions, including Google acquiring Raise, etc. What significance does IP or patent assets have in these type of M&A transactions?
So this is a question that is very interesting for me because, as you say, I actually specialize in intellectual property and technology transactions, and so it's close to my heart. But unfortunately, maybe for me, what I always hear from buyers in M&A transactions and from investors is that the IP is less significant than what people often think. In fact, there are other factors which are often the drivers of the transaction, whether it's the human factor, management or talent, or it is brand recognition or customer base, or first mover advantage. And so I want to emphasize that I'm not talking about any specific transaction because I was involved in my firm, Cleary Gottlieb, was involved in at least some of the transactions that you see on the slide, which I cannot see all of them, so there might be others. And only a few days ago, we represented Western Digital in the acquisition of SanDisk for $19 billion. And so we do all the time high-profile, IP-focused, technology-focused M&A transactions and IPOs. And I don't want it to appear as if I'm talking about any specific transaction or any specific client, because I'm not. But it is true that there is a gap between what people often think of the value or the significance of IP or patents on the one hand and the actual importance on the other hand. And I think this is the result of two very basic misconceptions that people have about patents. So now this is like 1 minute that is going to change your world. Here are the two misconceptions. Number one, people think that you need a patent in order to do something. In fact, you don't. You can build a product, you can provide a service, you can sell an app without any IP. You don't need patents for that. A patent right gives you the right to exclude others, not to do something. So if somebody else doesn't have the right to exclude you, you can do whatever you want. That's number one. Number two, misconception number two, having a patent right does not mean that you would actually be able to exclude somebody else. Because there's a long way between having the right and actually getting a court order that says that the infringer cannot use your patent. And this long way has become even longer recently because of changes in the law, especially in the US, that make it very difficult to defend patents, very difficult to collect high damages in patent cases, and very difficult to obtain injunctions, which are the legal term for a court order that says basically that an infringer has to stop using your patent. Now, a lot of those changes result from a very interesting phenomenon, which is the emergence of trolls. Trolls are not little green monsters. There are companies who own and buy patents for the sole purpose of going and suing people and collecting damages and royalties. They don't have an operating business. It's a huge phenomenon in the US, and it's starting now in Europe and elsewhere. In fact, some of the biggest patent holders in the world are trolls. They don't have any operating business. And so as a reaction to that, the US Congress, for a change, did something and made changes in the law. Courts are reacting. The US president has come out and said things about it. And this leads to changes that weaken the significance and the importance of a patent right. The other change that this leads to is that, believe it or not, using a patent to exclude a rival has become an undesired or undesirable corporate action. It's bad PR. Companies don't want to appear as if they go around and sue people. Companies actually come out saying that they will not use their patents to enforce them against somebody else unless they are first attacked. It's called defensive use. I will never offensively use my patents only in reaction to somebody else attacking me. Tesla, the electric car manufacturer, Elon Musk's company, said that recently. Twitter published their agreement with their employees, and those agreements say, we will not use the patents that you employees create for us unless we are attacked first. Google said that with respect to many of its patents. And so using a patent is not as a great thing for the corporation that it used to be. I often get calls or I talk to people, small companies, including in Israel, and they tell me, you know, we have these great 2 patents. They totally cover this business. Nobody can do that. You know, we're done. You know, everybody has to pay us or buy us or we'll have another way of great exit. And I need to calm them down and tell them, the fact that you have the patent, that's just, it's only the beginning. Maybe it's a nice platform, not more than that. Remember, a patent case is very expensive, and it's very naive to think that if you have a couple of patents and you go after a big company, the big company will just pay you or buy you. It's not going to happen. The more likely reaction is that the big company will hit you with a lawsuit with their 2,000 patents, not 2 patents, and will shut you down. And so it's a very complicated world. You have to be very careful. And there's this big gap between the right on paper and what it actually gives you. You can see that in statistics. So I looked at all the IPOs in the US in 2015 of Israeli companies, and I found that 25% of them had virtually no patents. Most of the companies had less than 10 patents. In M&A, I do that all the time. I know that buyers, including big companies, they are interested in the IP, they're interested in the patents, but the main concern that they have is not to get those 2 patents that will help them sue somebody else. The main concern is to have freedom to operate. Freedom to operate is basically the ability to do what you want to do, to sell your products without being hit by somebody else's patent. So the main efforts in those transactions is to make sure that somebody else actually cannot prevent you from doing what you want. Now, in order not to leave you with the impression that my services are not needed and that IP is not important anymore, I want to say 2 things. Number 1, IP is very significant. It's just that it's probably most often not the driver of M&A deals. Number 2, there are cases where IP will actually be the driver of the deal. And to identify those cases, I will give you a couple of clues. Number 1, when your company you're looking at has a product or product line that is covered by very few patents, it is possible that owning those patents will be key and will be a driver, just because if you own them, nobody else would. That is typical for some of the pharma companies. You can have a compound for treatment of malaria that is covered by a couple of patents, and if you have those patents, you're done with respect to that product. And that product can sell for $1 billion. It's true for some of the biotech businesses. It is not true for most of the internet-based applications and for the smartphone businesses. A smartphone is covered, some people say, by more than 200,000 patents. So the idea that owning a couple of patents or 10 patents or even 1,000 patents relating to the operation of the smartphone is going to change drastically the value of the company is just not right. So number 1, product lines that are covered by few patents. Number 2, another indicator of when a patent will be the driver of the transaction. Number 2 is when the innovation that you're looking at is groundbreaking rather than incremental. Unfortunately, many of the Israeli companies that are making exits have relied on incremental innovation. So they took an existing platform infrastructure that is already there, for example, most of the apps, and they build on top of that. However, when you have groundbreaking innovation, which exists, for example, in some of the semiconductor businesses, next generation semiconductor technology, that is when patents will be the driver. That is when the IP will be the most significant. In the incremental innovation, again, you will look more at the freedom to operate and at other factors. And finally, very, very relevant to China and emerging markets, there are companies out there right now who are desperately looking for patents in order to improve their defensive position. In other words, those are companies who are eager to go to the US and Europe, but they are concerned that when they do that, they will be sued by existing giant companies with tens of thousands of patents. And they want to enlarge their patent portfolio in order to create what we call a mutually assured destruction situation. Yeah, it sounds like the Cold War, and it is like that. So you build a huge portfolio of patents so that everybody knows that if they sue you, it's not going to be a 6-day war, it's going to be a world war. And like that, you create this freedom to operate. And so those companies, again, especially in emerging markets, are looking for patents that are great to add to their portfolio. And these are either patent-specific deals. I worked on the largest standalone patent acquisition in history when we sold the Nortel patents to Apple and Microsoft and Ericsson and RIM and others. It could be standalone patent, or it could be a company with a lot of patents where really the driver is to expand the portfolio.
Okay, thank you. I think just touching on further on that theme, again, I think that there's been some examples in the Israeli market that were quite obvious. And the question is, how much focus should Israeli companies be putting on IP? They spend significant resources, both capital and also manpower resources. Two examples in the Israeli market, for example, Given Imaging, which basically came out with a breakthrough technology for capsule endoscopy and a pill with a camera inside for scoping, etc. And they had, the concept was theirs. They patented the concept. They
redefined the phrase "the light at the end of the tunnel."
Thank you, Yossi. So clearly, they basically pioneered this concept. They had a broad patent estate, hundreds of patents, applications, etc. And then, of course, in 2005, Olympus just announced they're entering the market with the exact same product, with complete infringement, etc. Number two, another example, M Systems. Another Israeli company, they pioneered USB flash drives, which they call disk on key. They were the first, they pioneered the concept, they pioneered the product, they pioneered the launch, and then of course SanDisk and many other competitors entered the market. So again, not to belittle at all IP, the question is, how should Israeli companies be thinking about IP in terms of is it that important? Is it, in these examples, clearly it was not a main factor for stymieing competition, etc.
So again, being careful not to talk about SanDisk because we just did the acquisition by Western Digital. I think it's a big mistake not to invest in the IP, but it's a bigger mistake. It's a bigger mistake to think that just because you have the IP, you don't need to invest in the other aspects of your organization. Developing a proper business model, investing in people, in talent, brand recognition, making sure that your product has appeal enough and that you can create network effects. These are the important things, not instead, but on top of having the IP. Having the IP is important. The reality is that in those examples, I think at the end, there was some settlement and the Israeli company that had the IP initially didn't suffer that much. There was a nice exit, at least on the one on the left. And so it's not that it's not important, but nobody should think that it's enough. I see some other common mistakes of Israeli startups and other startups, frankly, in relation to intellectual property very early on. In the pharma business and biotech,